Imagine a single, quiet phone call. It is from an official at the Treasury Department to a major bank, confirming a routine, multi-billion-dollar payment will be delayed. There is no public announcement, no immediate panic, yet this one missed transaction is the first stone to be dislodged in a dam. In our complex financial world, the failure of a government to meet its most basic obligations, even for a day, does not start with a bang. It begins with a silent, unseen break in a chain of trust that millions rely on without a second thought. This single event sets in motion a series of questions few are prepared to answer. What happens when the safest asset in the world is suddenly no longer safe? The systems that underpin daily life are more fragile than they appear. A hospital waiting for a Medicare reimbursement. A defense contractor expecting payment for a shipment. A retiree watching for a Social Security deposit. All are nodes in a vast, interconnected network. The money they expect is the fuel for their own obligations. The moment that assumption is broken, the intricate dance of modern finance begins to falter. As of fiscal year 2025, statements showed total liabilities of $47.78 trillion against $6.06 trillion in assets, a technical state of insolvency. But the true weakness lies in the flow of payments. Next, we map the cascade. Baseline context, first-order consequences, second-order system effects, escalation, the altered long-term state, and the deeper payoff most people miss. The United States government runs on a combination of trust and debt. It borrows from investors worldwide by selling Treasury bonds, promises to pay with interest at a future date. Individuals, corporations, pension funds, and foreign governments all hold these promises. Banks use treasuries as high-quality collateral, treated as near cash across repo and clearing systems. This deep implicit trust is the invisible scaffolding of the modern economy. Debt held by the public is projected to reach 120% of GDP in coming years, higher than any point in history. As Hemingway wrote, bankruptcy happens gradually and then suddenly. Today, interest costs approach $1 trillion annually, exceeding the U.S. military budget. The government borrows new money to pay interest on old money, a cycle of dependency. Any rise in rates or dip in investor confidence can transform stress into crisis. Trust makes treasuries the foundation, collateral for banks, ballast for pensions, reserves for nations. When that faith is questioned, the architecture itself is at risk. On paper, insolvency is not the trigger. The crisis begins the day the cash stops. A technical default means specific payments are not made. Today, a group of bondholders might not receive a scheduled interest payment. A contractor supplying military equipment finds an invoice unpaid. An agency is told to halt payments to vendors. These are the first direct impacts. Real entities expected real money, and it did not arrive. Treasury makes millions of payments daily. Systems are not designed for selective default. Prioritizing bondholders versus contractors or Social Security versus federal payroll is a logistical and legal maze. Initial chaos and uncertainty are themselves sources of damage. Quick pulse check. If this breakdown helps you see the hidden machinery, tap like, drop your take in the comments, and subscribe to follow the full cascade. It keeps this investigation moving. The loss of predictability is the first domino, setting the stage for wider damage. Hospitals face immediate cash crunches. Reimbursements fund payroll, supplies, and electricity. Delays force postponements, hiring freezes, even limits on emergency services. For households, buffers are thin. Many live paycheck to paycheck. Financial strain is already rising. Consumer bankruptcies climbed 13.3% year-over-year in February 2026. When payments stop, the flow of money ceases. A single point of failure becomes system-wide contagion. When a payment is missed, treasuries are no longer risk-free. A bond worth 100 yesterday may be marked to 95 or 90 today. Lower asset values weaken bank capital ratios. Raising capital is near impossible mid-crisis, so banks sell assets. Synchronized selling crushes prices. Falling prices force more selling. A classic feedback loop. When sovereign credit is in doubt, every borrower looks riskier. Corporations face higher rates. Projects are canceled. Households see mortgages tightened and more costly. Higher borrowing costs slam the brakes on growth and revenue. Instability weakens the economy, lowers taxes, widens deficits, and erodes confidence. Weaker institutions can fail, risking bank runs. The Government Accountability Office has flagged these risks in a debt ceiling breach scenario. Interventions are constrained when the sovereign itself is in question. Foreign holders rationally rotate into euros, yen, or gold. The dollar falls, imports, oil, electronics, food get more expensive, stoking inflation. Inflation rises as growth falls, a devastating central bank dilemma. Raise rates, deepen the recession, or hold back and risk a dollar slide with accelerating inflation. Policymakers are trapped. Legal battles erupt over who gets paid first. Courts and Congress prolong uncertainty. Paralysis delays a credible resolution, and confidence erodes further. In 1998, Russia's default ignited global turmoil, not because of size, but because losses hit leveraged Western firms, triggering a chain reaction. Conversely, orderly restructurings with clear communication can contain damage. That is why debt ceiling standoffs are perilous. The uncertainty infects operations before default occurs. When no one knows who will be paid, rational actors hoard cash, sell assets, and cut credit. The preparation for chaos often creates the crisis, before the default is final. Analysts warn of a debt spiral when average interest costs exceed growth, a line the US could cross around 2031. If short-term funding jams, the system can seize within hours. Complex systems fail when predictability, not strength, breaks. Restoring predictability, not just numbers, is the key lever. What remains after the storm? If a severe fiscal crisis hits, the economy does not simply snap back. Treasuries would lose their unique risk-free status. Investors would demand a permanent risk premium. A bigger share of the budget goes to interest, year after year. The result, sustained austerity, higher taxes, or deep cuts to core programs. Globally, reserve holdings diversify into a multipolar system. Transition brings currency volatility and instability. Financing large trade deficits becomes harder. The nation must live within its means. Crisis response weakens. Stimulus triggers prohibitive rates and loses punch. Future recessions become deeper and longer, the safety net phrase when needed most. The big numbers are dramatic, but the timing and sequencing of failures determine ignition. A miss on patient long-term holders is painful. A halt to benefits or a repo freeze can be catastrophic within hours. History shows orderly processes restore stability. Disorder invites catastrophe. Clarity and credible sequencing can repair predictability faster than raw cuts alone. If you want more clear, mechanism-first explainers like this video, share a thought below and subscribe. It helps more people understand the wiring before it fails. The dollar's strength is less about force, more about the belief that tomorrow works like today. The real danger isn't a single number. It's hidden fragility in contracts, legal processes, and payment rails. Fixing debt is daunting. Keeping the chains predictable and unbroken is urgent. What scenario should we explore next? Share your ideas below. You've been watching If Verse, where imagination meets possibility. See you in our next reality.